Good morning. My name is Aditya Pattanaik. I am an investment advisor at Sprott. The following excerpts are from a discussion I recorded with Rick Rule on the 16th of October 2024. We discuss selected topics from the macro, gold, and silver markets, all of which suggest that we are still in the very early innings of renewed speculative interest in this precious metals bull market. Please email me if you have any questions or if you would like to schedule a call to discuss your portfolio in more detail. The Nobel Prize in Economics was awarded this week to the authors of a book called Why Nations Fail. And I thought the topic of this first question was very timely given what is happening in the gold market today. The premise of their research was that institutions determine the fate of nations and that nations start to fail when these political and economic institutions start becoming extractive and start protecting the political and economic power of a small elite over everyone else. Now, in the United States, the pace of both monetary and fiscal interventionism has accelerated significantly over the past few years. This year's budget deficit is on track to top more than 6% of GDP. This is a threshold that was only reached during World War II, during the GFC and the pandemic, and we're neither in a recession nor a crisis of any sort today. So the fiscal path is becoming more alarming from an economic point of view, but it's also becoming less relevant politically. And lawmakers are being rewarded for the resilience that is an upshot of all of this interventionism in a sense. So as a proponent of laissez-faire economics, I was very interested in your views on this contradiction that we're seeing an accelerating pace of monetary and fiscal interventionism by these institutions. But at the same time, we're seeing a surprising and continued resilience in the economy and a strength in the capital markets that cannot be explained without that interventionism.
Well, I think that our ability to fund our stupidity is a function of our savings. American society has been so creative and so dynamic for so long that our ability to have 5 or 6 young guys take over a garage in Sunnyvale and have Google or Apple pop out of it means that historically our individual creativity and tenacity has funded our collective stupidity. Hemingway once said, "You go broke very slowly, then all of a sudden." And I think that we need to heed his words. Our ability as a society to continue to live on our seed corn has limits. I don't think we've approached those limits yet, but I think we need to understand that those limits are there. The fact that as a society we're unconcerned about that has lots of parallels in history. We've lived through 40 years of the most benign climate, economic climate, at least known to humankind. And I see parallels myself to when I was growing up in the 50s and 60s, late 40s, but I wasn't around then. Post World War II, we had a tremendously benign economic climate. It lasted from 1946 to probably 1970, and people just believed things were going to get better and better and better and better and better, and they didn't. In the late 60s and early 70s, through the decade of the 70s, they got worse. And I think that we are unlearning the lessons that we learned in the 70s in favor of lessons that we learned in the period 1982 to 2022, just as we come into a period of change. Some of the statistics that you cited, the on-balance sheet deficit being equal to 6% of GDP is pretty scary. If you add that to the fact that the debt, just the debt service on the federal debt comes to something like 35% of total government revenues, at today's interest rates, that's scary too. But Aditya, a much scarier fact that you didn't touch on is the fact that in addition to $35 trillion in on-balance sheet liabilities, the US government has over $100 trillion, not my number, Congressional Budget Office number, $100 trillion in net present value, not nominal value, of off-balance sheet liabilities. These are things like Medicare, Medicaid, Social Security, federal pensions, military pensions. And it is estimated in some sources, including the Congressional Budget Office, that this accretion of unfunded liabilities, this is awful, exceeds $2 trillion a year. So if you add the accretion of on-balance sheet liabilities with the accretion of off-balance sheet liabilities, the number that you get, according to the government, is somewhere between $4 and $6 trillion a year. That number exceeds the total income of the federal government before any operating expense. And it's odd, but people are completely unaware of it. I had an online discussion not too long ago with a group of young money managers. And I visited with these people. And these are financially sophisticated people. These are not run-of-the-mill access to financial knowledge. And they were unified here that the net present value of promised unfunded obligations at the federal level exceeded $100 trillion. The only way, Aditya, the only way that you service that debt in a nominal sense is that you inflate away the net present value of the obligation. You can reduce the obligation, which we will, by means testing Medicaid, Medicare, and Social Security. In other words, disqualifying old folks like me who paid for it but don't need it. You can change Social Security qualifications by making somebody need to be 70 or 72 as opposed to 62 or 65. You can increase the copay for drugs. But the truth is, with a $100 trillion obligation growing between $2 and $4 trillion a year, the only way that you can honor nominally that obligation is to inflate away the purchasing power of the obligation. We did it in the decade of the 70s. In the decade of the 70s, we reduced the real purchasing power of the US dollar by 75% in 10 years. I think past is prologue. I think the next 10 years, the purchasing power of American savings and salaries will decrease by at least 75%. And traditionally, historically, one of the beneficiaries of that, or at least one of the ways that one maintains the purchasing power of one's savings, is in gold. Not coincidentally, I'm a reasonably strong gold holder for just that reason.
This is one of the primary discussions that I have with anybody who's been invested in precious metals over the past few years. The question a lot of people have is, why are free market forces not chastising the level of monetary and fiscal profligacy that you're seeing over the last few years? Instead, both the bond market and the stock market, they seem to be rewarding lawmakers, if anything, for this interventionism.
Again, we return to Hemingway. How do you go broke? Slowly, then all of a sudden. Voters and investors were schooled in the period 1982 to 2022 to buy the dips. They were schooled to having the wind in their sails. My suspicion is that the world changed in 2022 and that the expectation of investors hasn't changed to keep pace with the change. There are in my life historical precedents for this, Aditya. Although I was in high school in 1968, I came to understand that incipient inflation was going to be a problem. Well, I didn't have any money to implement any strategies associated with it. I was curious myself as to why other people weren't curious about it. And it wasn't really until 1972 that concern about inflation, 5 years after the experience of inflation, began to impact investor attitudes. When I talk to investors, which I do frequently about inflation, the statistic that investors use is the consumer price index, which is a totally erroneous guide to inflation, at least if you define inflation the way that I do, which is as a measure of the deterioration of the purchasing power of your savings relative to the cost of the basket of goods and services that you consume. If your experience has been the same as my experience over the last 5 years, the basket of goods and services, defined loosely, I don't consider government a service, but I understand I have to pay for it. The purchasing power of my savings has declined at 7.5% or so, compounded, not the 2.6% stated by the CPI. I think that you will need to go through a period for at least as long as 5 years, equivalent to 1968 to 1972, before the average American voter or investor understands that his or her paycheck and his or her savings is not depreciating at 2.6%, but rather at 7.5. When people look at the price of groceries, they think the price of bread has gone up. No, the purchasing power of the dollar has gone down. When people look at the price of gasoline, they think the price of gasoline has gone up. No, the purchasing power of the dollar has gone down. When people have enjoyed a 2.5% wage increase, they think they're making more money. No, their wages have lost 5% of their purchasing power. But the realization of that takes time. And not enough time has passed. When time does pass, the response is probably going to be consistent with the political response in the 60s and 70s, which is to say everybody is going to look around for somebody else to blame rather than looking in the mirror. And so I think we need to pay attention to that too. I think that the philosophical answer to the question that you're asking is that people don't take into account time. When people look at the experience of the economy, or they look at the response by each of investors or voters, they don't take into account that 40 years of schooling takes more than a couple years to unwind. And they don't take into account that change in corporate behavior and change in corporate performance, and hence change in the paradigm, the narrative around valuations, takes time too. People who invest for 5-year horizons and 10-year horizons invariably outperform people whose horizons are limited to a long weekend. And the understanding of history too involves the assumption of time, which most people aren't willing to incorporate in their thesis. Even people, Aditya, who are willing to incorporate it in the narrative thesis aren't willing to incorporate it in their performance. If you're invested in a 5-year narrative and you have a 6-month orientation, I guarantee you're going to lose money. I guarantee it. In January of this year, you and I talked about the fact that high quality silver stocks were a coiled spring, not because silver had to go up, but rather because the silver stocks, the high quality ones, were so hated that there was nobody left to sell. Now that a basket of high quality silver stocks is up by 100%, people are talking about the fact that silver is attractive. Could be, but it was much more attractive in January. The problem was that people who bought the narrative needed the price action to confirm the narrative, and they didn't have enough courage of their convictions to implement time, which should be their greatest ally.
So from 1970 to 1980 and from 2001 to 2012, during those periods, gold was rising against a falling Dow. So the ratio was falling. This time around, gold has risen alongside a rising Dow, which is different. I was interested in your thoughts on why you see gold responding the way it is today, given what you've just said about, people still not having spent 5 years in an inflationary environment to realize that they're in one.
Um, I think the reason for that is that the buyers of gold haven't been people; they've been foreign central banks. And the foreign central banks have been forced into the gold market because of the weaponization of the US dollar by the US government. If you are people in other countries who would prefer to exercise your own political will, your own prerogative, if, say, you were the Mexican government or the Brazilian government or the South African government or the Russian government, the Chinese government, the Indian government or the Indonesian government or the Iranian government, you have no choice but to begin to substitute US Treasury securities and the US dollar with another store of value and medium of exchange. The one that has historical precedent for that is gold. And if you are a foreign country, if let's say you're China, and you have a choice between Russian rubles, a worse currency than the US dollar, or gold, you're going to choose gold. The reason that gold has performed and the gold stocks haven't performed is simple too. The buyers of gold have been central banks, and central banks don't buy stock. They buy gold. If I'm right, and if the realization of the circumstance that we're in begins to cause individuals to return in mass to the gold market, they will return to the gold stock market, but that'll take time.
One of the things that stood out to me in this chart, and it's simply a pattern from history, is that gold bull markets, at least the last two gold bull markets, have had a very definitive 10-year sort of duration. In an intuitive sense, do you believe that there is a natural limit to these bull markets? And where do you think we are in that bull market today, given what you've just said that we haven't really seen individuals get involved yet?
The answer to the first question is, do they have limits? Yes, markets work, Aditya. And ultimately, the cure for high prices will be high prices, much as the cure for low prices were low prices. I believe that. How long it will take, nobody knows. At least I don't know. What I can say is this. My belief is that a higher gold price is a function of the deterioration of the faith and the reality of the maintenance of purchasing power of fiat currencies, in particular the US dollar. When the reasons for that fear goes away, the market response of gold will go away over time. There'll be a lag because people don't unlearn lessons quickly. Just as the gold price stayed stronger than it needed to in the early part of the decade of the 80s. But it will be true. So I will begin to trim my gold holdings when I see the reasons to have them disappear. Specifically, when I see US debt and deficits become less of a problem. When I see the ability of the US government to deal with short-term economic dislocation in ways other than quantitative easing. When I see the real rate of inflation less than the interest rate on the US 10-year Treasury. In other words, when I see the real equation, or rather the real accretion of value occur in the long bond, then I'll sacrifice my gold. But I don't see that happening anytime soon. I think that you need to extinguish the net present value of our on balance sheet and off balance sheet obligations by inflating away the purchasing power of the dollar first. I think inflating away the purchasing power of the dollar ultimately causes the bond vigilantes, which is to say the market, to reassert their role in interest rates against the Fed, changing a 40-year term. If we return to the interest rates that we enjoyed, if that's the right phrase, in 1980 and 1981, which is to say an 18% prime, I think that you would see a very different level of pricing in equities, in housing, in all those things. And I think that different level of pricing would, in a very ugly fashion, cure inflation. When or if that circumstance occurs, which is to say, when the nominal interest rate is substantially larger than inflation, then my gold will be gone in favor of the bonds, or in favor of utilities, or all of those other things that do poorly in inflationary periods. But I think that there's a long time between here and there. It took us the period between 1968 and 1982 to inflate away enough of the purchasing power of the US dollar that we returned to the circumstance that was in fact good for fiat currencies and bad for gold.
So that takes me to the second part of my discussion on gold.
Yep.
And you have alluded to this in the comments that you've made already with regards to the price action in gold over the last few years being driven by central banks rather than Western investors. But we are starting to see now, particularly since early March of this year, we are starting to see the miners come alive again, and we are starting to see them respond to what is happening in the price of gold because of central bank buying. That said, we're still in a very differentiated market where I am seeing companies which would historically have been early recipients of fund flows. These are companies with the higher return on invested capital numbers, the lower cost producers, the larger market cap companies. Even within that space, I'm still seeing a very differentiated share price performance. And what I'm essentially seeing across the landscape of opportunities in the mining companies today is that growth and leverage, which typically have been rewarded in a bull market, are not being rewarded in the same way as they were, at least in 2016 and in 2020. I was interested in your views on what is happening in the mining equities today.
Well, first of all, it's a completely accurate observation. What you describe is exactly what's happening. And I think it's happening for a few reasons. One reason is that we are very early in a bull market. And early in a bull market, people don't really believe. They're trying, but they're risk averse. So they are attracted to the very highest quality names in the sector. It is also true that with the increasing influx of passive money through ETFs, that size, market cap, and liquidity is important. People used to buy gold stocks at ETF. Now many of them substitute the ETFs for the gold stocks. And many of these ETFs are market cap and volume weighted, which means that the flow of funds come into the bigger companies first. The risk aversion, too, penalizes, ironically, companies with good growth profiles because those companies have uses of capital that the market is concerned about their ability to fund. And the market similarly penalizes single asset producers because of the perception, accurate perception, that a single asset producer producer is riskier than a multi-asset producer. The discrepancy that you talk about, the delta that you talk about, begins to change as a function of really three behaviors. People who experience good outcomes with conservative behaviors in an investment category begin to develop more confidence, and they begin to employ more risk in their portfolio because the outlook in the sector, or at least their performance in the sector, improves, and hence they become more aggressive. With regards to differentiation in terms of cost of capital, two things happen. Again, investors, including institutional investors, begin to come down market because they look at the discrepancy in valuation. And if the discrepancy in valuation doesn't occur, mergers and acquisitions do. Companies with a lower cost of capital, which is to say a higher share price relative to enterprise value, take over companies that are less well valued in financial markets. And the consequence of those three factors generally begins to erode away the delta that you have rightly observed between the GDX and the GDXJ. In the late segments of a bull market, people become much more interested in performance or relative performance. They become much more interested in leverage than they are in market fundamentals. And what you see in those circumstances is that the penny dreadfuls, the people who don't even qualify for the GDXJ, outperform all of the other sectors. I would suspect that if we see that phenomenon in this market, that it's time probably to exit the gold equities.
When you say you think we're early in this bull market, do you think that is with reference to where the price of gold is going, or how the valuations of these equities will discount current gold prices?
Yes and yes. I believe that the problem that is faced by fiat currencies is early in its resolution, which means that I'm afraid that the gold price goes higher. I think, too, that we will begin to see earnings surprises on the upside as companies begin to control their input cost while they enjoy sustained periods of higher gold prices. And I think that there will be an understanding that the benefit of higher gold prices is beginning to extend itself to the more efficient of the producers, which should allow some generalist flow into the gold stocks. I think the trend to merger and acquisition that we've seen will begin to accelerate as the delta between the cost of capital for some companies and the rest of the market continues. The more efficient companies in the market, the companies with greater market caps relative to enterprise value, will arbitrage away that gap that you talk about by taking over the other ones. So I think in sum, the answer to your question is yes and yes. The change, I think, is going to come because increasingly the gold equities market is driven by passive money, the ETF buyer. And the ETF buyer is likely to reward for longer than used to be the case the largest, more liquid companies. In other words, the market will suffer from an inefficiency because there won't be as much discrimination paid to the market on the valuations and qualitative difference between companies of different market capitalizations. The change in the delta will be affected by the companies themselves. As the passive money flows into the larger market cap companies, they will take over the smaller market cap companies rather than the market itself arbitrage away the difference.
part of the reason why I also asked you about where you think we are in this gold bull market is because I've often heard you remark that silver starts moving towards the latter stages of the bull market. And we've recently crossed a 4-year consolidation point on the silver price chart. It's been a very painful 4 years, but we've recently broken out. And you're seeing early signs of ETF flows into the silver ETFs, and you've also seen some of these silver names, especially the producers, have done quite well over the last 6 months. So there's money flowing into silver already. So in light of your comments about when silver starts outperforming gold, do you still feel that this is an early stage of this bull market?
Yeah, I'm not sure that we've seen a silver bull market. I think what we see is what you and I talked about in January, which is to say we exhausted the sellers. I think the ETF flows that we've seen are a consequence of the share price performance off a dead cat bounce. Yes, we've seen a market, we've seen an increase in the silver price. But my experience, and I can't give you a rational explanation for this, but my experience has been that you don't have to ask any questions when leadership changes, because the silver price increases so much faster than the gold price that no explanation is necessary or possible. And I haven't seen anything like that in the silver price. I've seen a couple things in silver equities. I've seen some companies generate extraordinary performance with the drill bit or at the mill, but much more performance on a corporate level than I had anticipated. And they got rewarded for good performance. But I also saw a succession of selling. I think that we absolutely positively used up the sellers at the beginning of this year. There were no bids in the sector. Just as every year in the penny dreadfuls, you experience this sell-off in October that goes through the end of December with tax loss selling. You almost always experience an upsurge in the stocks from January 15th to mid-March that has to do with a dead cat bounce. It used to get blamed on the PDAC, but the truth is that the reason to sell goes away. It isn't so much that buyers return to the market, it's that the sellers disappear. And in the junior silver stocks, I would suggest to you that most of the price action that we've seen hasn't been a predominance of buyers, but rather the fact that we used up the sellers. The price action that we have enjoyed has begun to attract the attention of passive speculators in the ETFs. But if past is prologue, Aditya, we ain't seen nothing yet.
You're also seeing that when you look at valuations of the silver companies. If you can see these two charts in front of you,
Mm-hmm.
the one on the top is comparing the P/NAVs of the gold miners and the silver miners. And there have been periods of time where the silver miners enjoy a premium in terms of their P/NAV. And today there is almost no premium being assigned to the silver miners.
What's the source of this data? It's very interesting.
It's RBC Capital Markets.
Yeah, but they're normally surprisingly good valuation firms. So I'm delighted that you use that. And frankly, I wasn't aware of this data, and I'm very attracted to it. I'll just say that it is very difficult to find a senior silver producer that doesn't operationally disappoint. And so it's been a very difficult place to allocate capital as an investor. It is easy, as an example, as an investor, to experience disquiet around political and social events in Mexico and Peru. It's easy as a fundamental investor to be disappointed by the operating performance of companies like Pan American Silver, or Buenaventura. So it's been a very difficult place to invest for a lot of reasons. It's been a better place to speculate, but I haven't seen evidence myself that the leadership in either the metals markets or the equity markets has shifted from gold to silver. I might not be smart enough to see that, Aditya, until after it's occurred. As I say, when you see a silver bull market, it doesn't take any particular sophistication. It's so dramatic.